The pitch was the cleanest part of the whole thing. No fees, not reduced. Zero. You wire the money, we buy you shares in a private company before it goes public, and we do not make a dollar until you make a dollar. Thousands of ordinary people heard that sentence and believed it. Teachers, retirees, contractors, people who had watched early insiders in companies like Uber and Airbnb turn a small stake into a fortune and decided they wanted one seat at that table before the door closed. Over roughly 3 years, more than 4,000 of them wired in $528 million. And on essentially every one of those transactions, before a single share was ever bought, money was quietly skimmed off the top. The Securities and Exchange Commission says some of those hidden markups ran as high as 150%. The man who built the sales machine was not legally allowed to sell securities at all. To understand how $500 million moves through a scheme like this, you have to understand what people thought they were buying. When a private company is expected to go public, its existing shares become one of the most wanted assets in finance. Employees hold them. Early venture investors hold them. Ordinary people almost never can. So an entire gray market grew up to fill that gap. Brokers who claim to hold pre IPO shares or access to them and sell slices to retail investors. Some of that market is legitimate, some of it is not. At the center of it is a New Jersey company called Late Stage Asset Management and a network of sales offices that marketed for it across New Jersey, New York, and Florida. 2 of those offices had names built to sell the dream directly. Prior to IPO. Pre-IPO marketing. Between March of 2019 and July of 2022, that network raised money from investors around the world. Prosecutors and regulators would later describe almost every part of the pitch as a lie. The salespeople used a tight script, reassuring in exactly the places an investor would worry. There is no upfront fee, they said. Your entire investment goes into buying the stock. We only get paid on exit. When the company goes public or gets bought by someone bigger, we take 20% of your profit. Not $1 before that. Think about how well engineered that is. It removes the biggest objection a skeptical buyer has, that the middleman gets rich no matter what happens to them. It puts the seller and the buyer on the same side of the table. It says, in effect, we win only if you win. That is the exact alignment every investor is taught to look for. The sales agents making these calls were not registered brokers. The Securities and Exchange Commission described a nationwide network of unregistered agents pushing unregistered offerings. And the offerings came wrapped in the most exciting names in the private market. Companies whose future listings were written about constantly in the financial press. For the person on the other end of the phone, this did not feel like a boiler room. It felt like access. It felt like the door that had always been closed to regular people had opened a crack, and someone was generous enough to let them walk through. 4,000 people did. But there was one name that never appeared on any document. Not on the marketing materials, not on the corporate filings, not even in front of the people who worked there. The man running the machine had gone to extraordinary lengths to erase himself from it, and the reason why was already sitting in a federal court record. Start with the money. The no-fee promise was not a shading of the truth. According to the SEC complaint, every single investor was charged an undisclosed upfront markup. Not some of them. All of them. Here is what that means in practice. Suppose the shares actually cost the firm $10. The investor is told the price is $15. $5 per share disappears into the operation before the investment even begins, and the investor has no way to catch it because they cannot check what the real price was. That gap is the entire business model. Prosecutors described markups ranging from 10% to 100% of each investment. The SEC went further, alleging that some markups reached 150%. At that level, an investor handing over $100,000 is receiving roughly $40,000 of actual stock. The rest is simply gone. Across the scheme, the amount taken in undisclosed markups came to more than $88 million. That money did not sit in a fund waiting for an IPO. It was paid straight out to the principals and the sales network. And notice what that does to the promise. The pitch said we only profit on exit. But if you have already been paid at the front door, the exit stops mattering. The company can go public or stall or quietly die. The operators got paid either way. Now the name. Raymond John Perello Jr., known in the business as Ray John, held no official title at late stage or at any of the sales offices. On paper, he was nobody. In reality, prosecutors said he worked as a partner to the company leadership and directed the heads of the sales offices on how the investments should be pitched. The reason for the disappearing act was simple. In August of 2019, a jury found Perello liable for insider trading. The SEC then barred him from associating with broker-dealers. By order of the regulator, he was out of the business, so he removed his name. The SEC alleged that the group went to great lengths to conceal his identity, and not only from investors, they hid it from potential employees as well. Sit with that for a second. People taking a job at these firms were not told who was actually running the place. This is the detail that separates a bad investment from a crime. A disciplinary history is public. Any investor can look up a broker in about 90 seconds and see a bar, a suspension, a customer complaint. The single most effective way to defeat that check is to make sure the name never reaches the investor at all. That was not carelessness. That was design. By the time federal agents came for him in December of 2023, the money was long gone. What happened in a Brooklyn courtroom earlier this year is the part almost nobody heard about. On December 6, 2023, a 3-count indictment was unsealed in federal court in Brooklyn. Perello was arrested that morning, charged with securities fraud conspiracy, and wire fraud conspiracy. The same week, the SEC filed a parallel civil case naming 5 unregistered brokers and 4 companies, including prior to IPO, late-stage asset management, and pre-IPO marketing. Then the case went quiet for 2 years, the way large securities cases usually do. Discovery, motions, negotiations. It ended in early 2026. On February 18th, Robert Casino, who led operations at Pre IPO Marketing, pleaded guilty to wire fraud conspiracy. 2 weeks later, on March 3rd, Raymond Perello and Joseph Passalacqua, the chief executive of prior to IPO, stood in front of United States District Judge Kiyo Matsumoto and pleaded guilty to all 3 counts of the indictment. A 4th defendant, Joseph Rivera, had already pleaded guilty before them. Perello and Passalacqua now face a statutory maximum of 45 years in prison. Casino faces up to 20. Read the prosecutor's statement afterward, and the anger is not really about the size of the markup. It is about the sentence at the start of every call. The United States Attorney said the defendants brazenly lied to investors all over the country about the fees associated with their investments and diverted millions of dollars in undisclosed markup fees to pay themselves and their co-conspirators. 4,000 investors. 1 sentence. No fees. So what does an ordinary person actually do with this? The lesson is not avoid private markets. The lesson is that no fee is one of the most dangerous phrases in finance because a firm that is not charging you a visible fee is almost always charging you an invisible one. Somebody is getting paid. If you cannot see how, that is the finding. 3 checks would have caught this one. First, ask for the price the seller paid, not the price you are paying. If a broker will not tell you their own cost on a share they are selling you, you are not being shown a deal. You are being shown a number. Second, look up the people, not the company. The SEC and FINRA both keep free public disciplinary databases. It takes about a minute. And if the person selling to you will not give you the full name of whoever actually runs the firm, you already have your answer. In this case, the missing name was the entire scheme. Third, be suspicious of alignment that sounds too clean. "We only make money when you make money" is a beautiful sentence. It is also the exact sentence you would use if you had already been paid. Fees you cannot see are not zero. They are just hidden. 4,000 investors sent in $528 million believing they had found the rarest thing in finance, a middleman with nothing to gain unless they gained first. More than $88 million came out of that money before the first share was ever purchased. And the man who designed the machine had already been barred from the industry when the phones started ringing. Here is my question for you. If you were on that call, and the pitch was pre-IPO shares in a company you actually admired, no upfront fee, 20% only on exit, what one specific question would you have asked to break it? Not hindsight. An actual question. Put it in the comments, because the good ones down there are usually sharper than anything the regulators publish. If you want more cases like this, the ones that end in a courtroom instead of a headline, subscribe. There is a new one every week.